This video is an Uncovered Japan Company research report on SEIKOH GIKEN, ticker 6834. It is a Japanese precision parts maker whose connectors, ferrules, polishing machines, and inspection equipment sit inside the optical backbone of AI data centers. The key question is whether a rare independent specialist can sustain exceptional optical profits through a cyclical technology build-out. SEIKOH GIKEN's appeal is easy to see in the current scorecard. In the year to March 2026, sales reached 30.1 billion yen. The optical segment earned a 33.1% operating margin, and return on equity rose to 20.1%. The balance sheet held roughly 18 billion yen of net cash. But investors are also paying around 27 times trailing earnings, so the next milestones matter. This is the practical product story. Fiber connectors and tiny ferrules align optical cable inside high-speed networks, while polishing and inspection equipment helps manufacturers produce and test those components. SEIKOH GIKEN participates on both sides. It supplies the components, and it also supplies machinery to other producers. That dual position is why the company has more than a standard connector volume story. The 5-year chart shows a step change rather than a smooth trend. Revenue was broadly flat through fiscal 24, then reached 30.1 billion yen in fiscal 26. Up 50.6% year-on-year. Operating profit accelerated still faster, rising 174.5% to 7.73 billion yen. That is powerful operating leverage, but it also means earnings are unusually exposed to the direction of the optical cycle. The segment split explains where that leverage came from. Optical products generated 67% of group sales, but 86% of operating profit, with a 33.1% margin. Precision machinery remains a useful, cash-generative second business, but at a 10.7% margin, it is not the growth engine. The central strength and risk are the same. The company now depends heavily on one high-margin optical segment. Financial resilience is a real advantage here. The equity ratio was 81.2% at fiscal 2026 year-end, with essentially no interest-bearing debt beyond minor leases. Return on equity rose to 20.1%. But the chart also puts that result in context. ROE was only 2.8% in fiscal 2024. The balance sheet can fund capacity and potentially acquisitions. It cannot make the optical demand cycle disappear. Net income broadly tracked operating profit, reaching 6.21 billion yen in fiscal 2026. Operating cash flow was also a record, 5.48 billion yen. The nuance is working capital. Receivables and inventory absorbed around 2.3 billion yen while the company scaled. That is a normal consequence of rapid manufacturing growth, but it is a useful reminder that reported profit and immediately available cash are not identical. The competitive advantage is not simply that SEIKOH GIKEN makes connectors. Its precision requirements are difficult to qualify, and its polishing and inspection machines create a second point of customer attachment. It is also independent of the large Japanese cable groups, allowing it to supply a broader set of customers. As Hakusan joined Furukawa Electric, that neutral position became scarcer. The caveat is that the larger groups still have more capital and scale. Management is investing ahead of the next optical wave, including multi-fiber connectivity and the heavy plant in China. Its net cash creates strategic flexibility, including for acquisitions. Yet there is a forecasting lesson in the record. Initial guidance missed badly during the previous slowdown and then was exceeded dramatically in the current boom. For this company, guidance is a starting point, not a dependable endpoint. Valuation is where the story becomes more demanding. Using fiscal 2026 earnings, the trailing PE was 27.2 times, and the forward PE was 26.4 times at the report date. That is high against the broader electrical machinery sector, though closer to optical communications peers. Historically, SEIKOH GIKEN traded closer to a 14 to 22 times range before the AI re-rating, leaving the multiple exposed if confidence in optical demand weakens. The report's own scenario framework makes the trade-off clear. Its fiscal 2029 base case implies 16,865 yen per share, slightly below the 18,930 price on the report date. The bull case reaches 32,105, while the bear case falls to 6,892. These are author estimates rather than forecasts, but they show the sensitivity. Sustained growth and an optical peer multiple are both needed to support the current valuation. To sum up, SEIKOH GIKEN is a rare independent optical and equipment specialist with real precision-based advantages, a strong balance sheet, and exceptional recent profitability. The important risks are just as concrete. Optical concentration, the possibility of an AI capex air pocket, competition from larger cable groups, China exposure, and a valuation already above the report's base case estimate. This is not investment advice. It is a research framework for tracking the evidence. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.